Okay, all right. So I'll just quickly recap whatever we have been doing in final accounts, then only we'll move forward. So journal, I'm not going to revise today. Whatever we did in journal, we did. Then we prepared the ledger. Then we prepared the trial balance from the ledger. And from trial balance, now we are at final accounts. What we are doing here is, we are preparing two statements called, one is called trading and profit and loss account. Another one is called balance sheet. So trading and profit and loss account gives us the net profit. So the profit that we have earned during the year, and the balance sheet gives us, can somebody tell what was the name that I introduced? Balance sheet gives us?
Trial balance?
No, there was another name, specific name that I gave. Wealth, to be very exact. Wealth of a company you get to know from the balance sheet itself. Absolutely correct. So how much really the company is worth, how much the company is worth, that is what is called wealth. And that is, carried by the balance sheet, is represented by the balance sheet. And in order to do that, we were introduced with a very simple chart, which looked something like this. Give me 1 second. Yeah, so this is the one where we saw that balance sheet will have assets and liabilities, and profit and loss account or trading and profit and loss account have expense and income. So profit and loss account will carry all the nominal accounts, while the balance sheet will carry all the real and personal accounts. Now, how to distinguish between assets and liabilities and expense and income? I had a very simple formula. Whichever the nominal account has a debit balance in the trial balance will be treated as an expense. Whichever nominal account which have a credit balance, then it will be treated as an income. The same way for balance sheet, whichever real or personal account which have a debit balance in the trial balance will be treated as an asset. Whichever is credit balance will be treated as a liability. So often we will not have to think about all this because we'll be so familiar with the terminologies those are used in the trial balance in the question, that but just looking at it, we'll get to know whether it's an expense, whether it's an income, whether it's assets, which is the liability. But whenever there is any doubt, just come back to this rule and it will help us start with, what type of account it is. If it is a nominal account, then it will definitely be either expense or income. If it is a real or personal account, it will definitely be assets and liabilities. Having that said, I had one more thing, which was how, we had a concept of determining the journal entries for few adjustments. And the concept of adjustments that I told was, often it happens with companies that after we finalize the trial balance, then certain transactions come to picture. So for those transactions, what we do is we do fresh journal entries. However, because we have already finalized the trial balance, we are going to see something, that instead of passing the journal entries, how to really make the proper treatment of those transactions, so that our profit and loss account and our balance sheet will be reflecting proper correct amounts, or it would show true picture. So during this process, we had a lot of new terms that came to our knowledge. One of them was bad debts. I'll just revise very quickly those very few terms, and after that we'll continue with that sum. So bad debts, when it came, I talked about a very simple example where I took an example of a wholesale. When somebody is taking some goods, purchasing some goods from us and telling us that I'll pay after a week or 2 weeks, then suddenly he goes off, we cannot track him, he has gone somewhere, or something has happened because of which we have an expectation that we have lost that much of money. Then only in those cases the concept of bad debt comes in. So we at that point of time assume that we will not receive that money, and because of that we strike off his name from our books. How do we do that? We give it a credit. We give it a credit, assuming hypothetically we have received money from him, and we do that. And the amount of expense, the amount of loss because of that, is called bad debt. And then we had the concept of drawings that came in. I have always, I think, repeated again, time and again, that drawings is nothing but the amount of money that the owner has taken from the business. So if the owner has invested some money in the business, that's called capital. However, if the owner has taken some money from the business, that's called drawings, which is exactly why, if you remember, I'll reconnect to the fact that so capital is exactly opposite of drawings and vice versa, meaning that the capital is asset or liability. Can somebody tell me? Capital is asset or liability?
Liability.
Perfect, because business owes that money to the owner.
Yep.
Absolutely correct. So if the drawings is exactly opposite, that means I can say it is a asset. Or I introduced a term called contra liability also, I can tell. So I'll focus on a little bit more on that as well, a little bit afterwards. So after this, what we did was a lot of other terms also came in. Something called provision also came in. Provision can be, associated with, or a provision can be a prefix for a lot of expenses. Provision for salary, provision for rent, provision for bad debt, and so on and so forth. So what is the concept of provision? When we are standing on a particular point, when we have not incurred a particular expense, however, we have an expectation in couple of days, there is a chance of us making that expense, incurring that expense. In those cases, what we do is, even though we have not incurred the expense, still we record that in the books. I'll repeat that. So provision is nothing but when we have a particular expense, for example, salary. For example, salary, we know that, for this month, we have to pay certain amount of salary. However, suppose for this month, we have not paid. Suppose something has happened with the cash, we don't have enough balance in the bank book, and because of which you have not paid. However, this concept tells us, even though you have not paid, still you have to incur this expense. You have to book this expense in your books because you have high expectation that you are going to incur this expense. Because there is absolutely possibility that you have to pay the salary after a few days. So in order to show correct pictures of the financial statement, profit and loss account, you have to incur this expense or book this expense in your books. So this concept especially came in when we were dealing with the bad debts. Bad debts, what we had in the discussion was, for the few small companies, they'll get to know who are the customers and they'll pay what amount of money. Out of them, if somebody is there who is not able to pay back, then we can take a call on whether he's a bad debt or not. However, for a company which is a big one, for whom there are lakhs of customers in their books, for them it is absolutely impossible, and it would be very counterproductive for them to go one customer by customer and determine whether the money is going to be is receivable from them, or should it be charged to the bad debt. So what they do is, they see the historical data and determine on that basis that how much of percentage of the debtors normally go bad. And in our example, it was 5%. And suppose the debtors was of certain amount, then 5% of the debtors is assumed that they will go bad. So that is what is called provision. Now that we are discussing this, let me bring in one new concept, then I'll move forward. Give me 1 second. Yes. Suppose last year when I created the provision, it was coming as 5,000 rupees. Last year when I made the provision, it came as 5,000 rupees. This year when I calculated the provision, it came to 2,000 rupees. So let me tell you. So this is the provision on that date, on last year's date. And this is the provision which is on this year's date. Now my question is, how do we see the 5,000? So basically what it means is, last year we recorded a provision of 5,000. So we thought that, out of the debtors, whatever we have, out of them 5,000 are going to go bad. So those money we are not going to receive. However, this year when we saw whatever balance of the bad debts that we had left with, we were left with, out of them only 2,000 of them seem to be very bad, as per the percentage or the historical data percentage, whatever we have, as per that. Now let me suggest this. Okay, do you think that there is a gain or income that is happening here?
Yes, its income is
So
happening because
yes, because
there's a reduction, like the
yes,
5,000 get reduced to 2,000, right, in this year.
absolutely,
So
absolutely. Absolutely, you're absolutely right. Exactly on the point that I wanted to make. Why I'm introducing this is, so what happens is, if the provision of last year was a little bit more, but provision of this year is a little bit less, then the differential amount, it will be termed as a profit, and it will directly hit the profit and loss account. It will directly hit the profit and loss account. The reason is very simple. When you created the provision, how did you create? You debited the, do you remember that entry when we created the provision? One second, I'll show you the entry. We have it here. This is the entry we made. So bad debt account debit to provision for bad debt. Bad debt is nothing but an expense. So when we are incurring an expense, we are debiting an expense. That means ultimately, indirectly, we are decreasing the profit. So I can say, if I connect those dots, we created the provision by decreasing the profit. Is that right to say? Does anyone have any doubt in that? Okay, I'll take that as a no. When creating the provision, we decrease the profit. Now that we are realizing, we are realizing that provision was actually reduced, then we have to increase the profit. That's what is the concept that I wanted to discuss. So whenever there is a change in the provision, which account will be hit? It will be the profit and loss account. Now I'll use this concept a little bit afterwards. Now, having that said, what we did afterwards was we went through all the adjustments and we passed entry for those. I'll tell you why we did that right now. So if you see the content that sir has given, or the questions there, you will see a lot of add, less, this and that. If you guys can see on the other side of the screen, there are a lot of add and less, those are happening. Now I prefer, instead of doing that, we go for journal entry and ledger. I tell you that there will be no mark deduction. It's absolutely correct in the other way, which I'm going to do as well. So instead of doing all of this add and less, we are going to prepare the ledger accounts of all those items for which this is a requirement. Now, when this is a requirement, the concept is, as we know, the adjustments, whatever transactions those are given in the adjustments happen after the trial balance. We actually pass the journal entry for those and then post those journal entry to the ledger, and final balance we take to the trading and profit and loss account. I'll repeat that. So we have already, recorded all the transactions here. I'll just quickly recap whatever we have recorded and why we recorded. The first entry was charge interest on loan of 10% at the rate of 10% on 3,000. So we have charged interest on somebody. So definitely we have given a loan to somebody, we have charged the interest. So the two aspects are interest receivable and interest amount. Interest is nothing but your income, and interest receivable is nothing but representing the person who is to pay you the interest. Now, interest receivable, as it is representing the other person, so it is a personal account, and interest, as I said, it is an income, so it is a nominal account. So personal account, debit the receiver, credit the giver. Nominal account, debit all expenses and losses, credit all incomes and gains. Debit the receiver, credit the giver. Here the person is receiving the loan service. Therefore he is a debit. Now interest is an income, so definitely credit. Now according to the entry says, interest receivable account debit to interest account 300. Now that we are discussing about this, let me introduce one more concept, which is called accrued interest. One concept of accrued interest. I'll give you an example. Okay, suppose I have given, our company has given somebody a loan of 1,000 rupees. 1,000 rupees, very simple, at the rate of 10%. At the rate of 10%. Now, However, when did we give this loan? Suppose we gave this loan on 2019, September 1. So 2019 September 1 we gave the loan. So and we charge annual interest of suppose 10% annual interest. So annually we charge. So the next time we will charge the interest will be on what date? Can somebody tell? When will we charge the interest?
End of financial year.
No, I told 1 year. That's the contract. That's the agreement with our company and the other party.
So September 1st, 2020.
Perfect. So I can say other way around, 31st August 2020. Yeah.
Yeah.
Both are same only. What you said absolutely correct. So on that day, the interest amount will be 1,000 into 10%, which is 100 rupees, nothing else other than that. So let me just revise that loan amount a little bit. Suppose we give a loan amount of 3,000 instead of 1,000, just to be similar with the question that we have here. Now, let me bring in a concept like this. Now, because we gave the loan on September 1st, 2019, on the date of 31st December 2019, on the date of 31st December 2019, we have not charged the interest. However, have we earned some interest? So my question is, I'll repeat that question. The words are very important. We gave a loan of 3,000 rupees on September 1, 2019. And we are charging interest per annum basis. So the next day on which we will charge the interest is on August 31st, 2020. However, on the date of 31st December 2019, when we are preparing the financial statements on that date, do you think we have earned some interest?
Accumulated amount of 3,600 we might have earned.
Fair enough. Concept, I got it. Yeah, anyone else? Can I say in 12 months, I'm getting 300 interest?
Yes.
From September 1 to December 31st, how many months? September, October, November, December, which is 4 months, right? Yes. So out of those 12 months, 4 months have already passed, right? So yeah. Can I say that 3,000 divided by 12 multiplied by 4, this much of interest I have earned, even though I have not charged that interest.
Right.
But because the time has elapsed and the money has been used by the other person, so I have earned that much of money, right? That much of interest, even though I'm not charged because I haven't charged because of the agreement that I have. Does anyone have any doubt on that? Okay, no. I'll take that as a no. Good enough. So that amount of money is called accrued interest. So accrued interest is interest earned but not due. So I'll repeat that. Accrued interest is interest earned but not due. Not due, why? Because as per our agreement, we'll have to make that due after 1 year only. Why is it earned? Because time has elapsed. So here accrued interest is 100 rupees. Does everyone agree with that? Yeah. So when we will be making the interest, why are we discussing about all this? When we will be making the entry for interest receivable, if you remember the first entry which we just discussed, interest receivable to interest account, because the interest receivable is a personal account and he is the receiver of the loan service and interest is the income. How much should be the entry for? Not 300. It should be for 100, isn't it? Everyone agrees to that? Any doubt on this? No. Okay, I'll take that as a no. Perfect. Now let's go to depreciation on furniture, and it was very simple. One aspect was furniture, and another was depreciation. Furniture is a real account, depreciation is a nominal account. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. Here, even though furniture is not going out, however, a portion of the furniture is reducing. A portion of the furniture we are losing because of the wear and tear, and because of that only we assume that that is actually going out and it is a credit. And then depreciation, it is an expense, so debit. So depreciation account debit to furniture account, 10% of 7,250, which is 725, 725. Bad debt of 500. So as I have repeated again and again, I'll repeat this again. Bad debt, what is bad debt? Bad debt is nothing but when you realize that from somebody you are not going to receive any money, then you are incurring a bad debt. You are incurring an expense, and the two aspects in it are debtor and bad debt. Debtor is a personal account, and bad debt is a nominal account, which is the expense. As I said, it is an expense, so nominal account debit all expenses in expenses and losses, so it will be debited. And debtor, it is a personal account, and even though he has not given, however, hypothetically we are assuming that he has given because we want to strike off his name. So the entry is bad debt account debit to debtor account, which is 500 and 500. Now, very quickly going to provision for bad debt. So on the end of the year, we determined that 5% of the debtors, which is 49,700, we will be charging us provision for bad debt. So provision for bad debt is nothing but, I'll repeat that. When we are, we have lakhs of customers with us, and we don't, we cannot go customer by customer, who is receivable, who is not receivable. Then what we do is we see the past trend and determine a percentage, and on that basis, we determine how much of provision we should make. Now, the aspects for that are, one is bad debt, another is provision for bad debt. And provision for bad debt is nothing but it is a kind of another name for debtors only. It is another name for debtors only, and it is a liability or I can say contra asset. So bad debt is a nominal account, which is an expense, so definitely debited. And provision, as I said, it is nothing but another name for debtor. And in the same concept of this entry, here for the purpose of striking off his name, we are now crediting, assuming hypothetically we have received the money. Now the entry is bad debt account debit to provision for bad debt, which is 2485, which is 5% of 49,700. Then we have the transaction of goods costing 1,500 destroyed by fire. Goods are getting destroyed is a very simple thing. I don't think there is any other explanation needed. Two aspects are, one is a loss by fire. Loss is fire is nothing but expense. And then another aspect is the goods. So while deciding with what should we name the goods, we determine, on that point of time, which account would be representing the goods. We determined that because the goods were there with us, that means the sale had not happened. So definitely it would have been in purchase only. So the name will be purchased. So which is again another name for goods only, which is exactly why that is a real account. Loss by fire, like I said, it is an expense or loss. That is a nominal account. So debit on expenses and losses. So debited. Real account, goods are here going out because the fire thing has happened. So credit. So loss by fire account debit to purchase account, 1,500, the amount is given in the question itself. Now, out of that 1,500, we have received back 1,000 rupees from the insurance company. Now, here the two aspects are, one of the aspects definitely is the insurance company who has to pay us the money. The other aspect is the income that we are making. The income that we are making. We had a comparison of insurance income and loss by fire. And I told the concept of, because we have already recorded the expense by 1,500 on the account of loss by fire. So it will be wrong if we are not reducing that. It will be wrong if we are not hitting that, because actually the loss is not 1,500, loss is actually less because we have received some money for that. So another aspect is loss by fire, which is here treated as an income, which is exactly why it is a credit, as the nominal account golden rule is debit or expense and losses, credit or incomes and gains. Insurance receivable, again, it is representing another name for the insurance company. Now here they have to pay us. So meaning that they are the debtor. So we had the concept of debit the debtor, credit the creditor. So there will be debit on that concept. The entry is interest receivable account debit to loss by fire. Now let me bring in one more new concept, something like this. I'll tell you what. Suppose in my trial balance, my debtors, sorry, not debtors. I'll take one more thing. Yeah. Suppose my furniture were 7,250. Okay. Suppose just forget everything else. Just think about this. Suppose my furniture in the trial balance was 7,250. What does this mean? I'll just quickly revise. What does this mean? We have actually purchased a furniture and we have had other transactions related to the furniture. We have recorded all of those transactions in the journal entry. Then we have passed the ledger for all the journal entries. Then we have balanced the ledger. Then we have found the balance, the final balance of the furniture account that we have taken to the trial balance. Now, after preparing the trial balance, you got to know that the furniture is reduced by how much? 725 rupees. So your furniture account is reduced by 725 rupees because of what? Because of depreciation. Now, can I say if I make a simple ledger account of the furniture, something like this, furniture, and I will say to balance brought down, and I will say the amount is 7,250 rupees. Now I'll ask you a question. Why did I put it as to balance brought down and not by balance brought down? Can somebody tell me? Guys? Why not by balance brought down? Anyone? Yeah.
No idea.
Okay. So the reason is furniture is what balance? We had that chart with us. Here, furniture is definitely real or personal account. Furniture is definitely an asset, meaning thereby it is a debit balance. I've always told no. So debit balance means what? The brought down is in the debit side. We determine the other way around. Whichever side is the brought down at, that is the balance of that particular account. So here, if the particular asset is say 7,250, which is we know that it is a debit balance, then the brought down will be in the debit side. The brought down will be in the debit side. Now we have to reduce. Is that clear? Is that concept of brought down in the debit side clear? Guys, anyone?
Could you please repeat once more here?
Yeah, sure. Sure. So when we were preparing the ledger accounts, and from the ledger accounts, we were preparing the trial balance, which was here. So there, what we had was we had prepared the ledger like this. And while preparing the ledger, we had balanced both the sides, and then we had actually calculated the differential amount on the lower side, and we had taken that amount to the other side. So while doing that, I had told actually the reason we do that is to determine what type of balance a particular account carry. In order to determine that, we just look at the brought down. Which side is the brought down is, meaning thereby, if I ask, what balance does RAM account carry? We will say it's a debit balance. The reason is the brought down is in the debit side. If I ask, what balance is the purchase account? We will say debit balance because the brought down is in the debit side. If I ask, what balance does the cash account carry? We will say debit balance because the brought down is in the debit side. Exactly the similar way, if I ask what balance does Mr. Abdul account carry, we will say credit balance because the brought down is in the credit side. Now, if I ask the other way around, we have the balance of Mr. Abdul account. We know it is a credit balance. Which side the brought down should be? On the debit side or credit side? It's easy to determine it's a credit side, right? Yeah. So that way I'm linking it. Yes. So furniture account, because it is an asset, so debit balance, meaning that the brought down will be in the
It's
debit
something
side.
like where it is low, right? Where it is less amount compared to the two columns, right?
Yes, something like that only. Whichever side is the higher, that side is actually put. The brought-down is on that side. Anyways, now that that is clear, okay, I think in less than a minute the meeting will be over. We can just join back immediately on the same link. I'll come immediately and we can carry on with it. So now what I'm trying to do is here. So I got the 7,250 from the trial balance. Now, just a few moments back, we have entered an entry called depreciation account debit to furniture account. And mind you, this entry is after the trial balance. This entry is after the trial balance. Here, the furniture account is debited or credited? In this entry? Credited. So if I post this entry in the ledger, which side it will be posted in?
Credit balance.
Credit side, right? What will be the particulars?
Yeah, by balance.
By the
By
other
balance
aspect, right?
carried down.
No. By the other